And I'd like to thank the organizers of ABM4Policy for the possibility to present our research on an agent-based housing market model in which we try to make a one-to-one mapping of Hungarian households to analyze the housing market and mortgage lending in the housing market for macroprudential policy purposes. Four of us at the Central Bank of Hungary, or Magyar Nemzeti Bank, are working on this research project. Besides myself, it's András, Borsos, Zsuzsanna, Hosszú, and Nikolett, Vágó. Regarding this presentation, the usual disclaimer applies. In the introduction, let me give a short overview of the model, highlighting its unique features. After the introduction, I will give some details about the structure of the model. Then I will talk shortly about how we populated the model with agents, what databases we used to do so. Next, I will show the results of calibration and validation. And finally, I will show the results of 3 applications: the effect of a COVID-19 shock, a moratorium policy simulation, and simulations regarding the macroprudential instruments of loan-to-value and payment-to-income requirements. If we would like to develop a model of the housing market for macroprudential purposes, we need to model the income and the losses of the banking sector on mortgage loans. To have a profound estimation of these losses, it is not enough to have a representative agent with a homogeneous housing good. Because besides the probability of default, the loss given default depends on individual loan characteristics and the individual market value of the collateral. And so it was straightforward to develop an agent-based model of the housing market. To estimate the effects of different policy measures, obviously, we wanted to use empirical data. And since we have granular data on loan contracts, on housing market transactions, instead of making random samples, we try to replicate the 4 million households and 4 million flats of Hungary. These 4 million flats can be sold and bought in the housing market or rented in the rental market. So some households live in their own property and some others rent the property of investors if they cannot finance home ownership, if they haven't yet accumulated enough down payment to purchase an own property. We used empirical data in empirical time, and we tried to reproduce the house price dynamics in Hungary for 2018 and 2019. And we hope that what the model predicts for later periods, it could be used to have an approximation for collateral values. So we do not wish to interpret the results for average house prices as a forecast. We have housing loans in the model, which is a crucial factor in financing the purchases in the housing market. We implemented a procyclical banking sector, and housing loans are regulated by a macroprudential authority. There are LTV and PTI requirements, which are caps for the banking sector, but the banking sector may prescribe other requirements as well. In the model, we have a construction sector, which builds high-quality flats, and it may renovate flats as well. And so in the long run, it may accommodate the distribution of flats regarding size and quality to the needs of the constrained households. And as I've already said, we have a rental market and we have buy-to-let investors purchasing flats to rent out or selling flats if there is excess supply in the rental market. These components already yield some of the unique features of our model. In most agent-based housing market models, flats have 1 or 2 characteristics: some kind of quality, which can be either a continuous or a discrete variable, and in some cases, it can have a location. In our model, flats also belong to a location. They are situated in different neighborhoods. Now, each neighborhood has a different level of neighborhood quality. Flats have a size, which is continuous. And since the construction sector builds high quality flats, flats have a state characteristic as well. There is depreciation. So the state of a flat decreases month by month, but there is renovation in the model. Each month, some households may decide to renovate their flats, which has a cost. And by renovating a flat, its state increases. When households decide which flat to buy, they use a utility function, which includes the three characteristics of the flat. And this function assigns a reservation price for the flat. Households make bids for the flats based on their consumer surplus. After making the bids, we used a weekly auction logic. The second highest bid is paid by the highest bidder. We try to approximate a full-scale mapping of the households and the housing market to empirical data. We have a construction sector operating in every period, not just during initialization. The aim of the construction sector is not to populate the model with an initial stock of houses. We used empirical data for it. The construction sector is operating in every period, fulfilling demand for newly built flats. And so we try to model the demand for newly built flats. To build, the construction sector needs to buy sites. The price of newly built flats depend on construction cost and land cost, and land cost may differ neighborhood by neighborhood. Finally, we have implemented many small rules, even though some of them can be found in different models as well. To name the most important, we implemented family support like tax allowances and transfers. In Hungary, transfers directly affect the construction sector because families can get significant transfers to purchase newly built flats. Households have minimum consumption. There are variable rate mortgage loans. And if loan contracts become non-performing, first the bank tries to restructure the loan. And we also have a sophisticated PTI rule, and there can be migration within the country. Now, this model can have many applications. In this presentation, we would like to show three. We made an impact assessment of a COVID-19 shock. We made a loan payment moratorium analysis. And finally, we made an LTV and PTI simulation. I will tell the details of how these simulations were performed when I get there. Okay, so let's have a closer look at the model. So we have many flats in the model. As I've already said, flats have three characteristics. Each one has a location. We usually refer to the location as a neighborhood. Besides the location, a flat has two continuous characteristics, state and size. Size is constant, but the state changes. Each month, a flat state depreciates, but renovation can increase the state of a flat. Within each location, flats are grouped into buckets. And flats within a specific size and state interval constitute a bucket. We collect info about these buckets, which may affect the decision of agents. For example, we collect the demand for newly built flats in buckets. So the construction sector knows which size category to build. And we collect the number of flats rented in a given period and how many flats for rent were vacant in a period in a bucket. And these info help investors what kind of flats to buy, to rent out. In the housing and the rental markets, there are different motives for demand and supply. Households would like to own an own home, a house. Period by period, they accumulate savings. And if they can make a proper bid for a preferred home, they do so. Making a proper bid means they have enough financing for it. So in case they need to take out a loan, they meet the regulatory requirements. They have enough down payment regarding the prevailing LTV regulation, and they have enough income for the monthly installments to meet the PTI requirements or other requirements prescribed by the bank. In our case, households should have a certain per capita income after paying the monthly installment. Regular households may appear on the supply side when they inherit a flat and take it to the market. We implemented demography into the model, including birth and death according to empirical data. Each period, some households may decide to move if they find that they can achieve a significant increase in their surplus by selling their home and moving to a new one. In this case, these households participate to both sides of the market. There are buy-to-let investors who offer properties for rent in the rental market. And if there is disequilibrium in the rental market in some of the buckets, then they can act as buyers or sellers. Their decisions are affected by price changes because they consider capital gain. And so if prices increase, they tend to rather buy, and if prices decrease, they tend to rather sell. And we have a construction sector represented by a construction firm which estimates demand for newly built flats in different buckets according to an adaptive rule. To fulfill the demand, it builds high quality flats, but it needs land side to do so, and buys the flats with the lowest unit costs for sale in the neighborhood where it wants to build. And after constructing the flats, obviously it sells them. Now, in the rental market, in the demand side, we have households without an own home who need to rent a flat to have a place to live at. Actually, for these households, paying the rent makes it harder to accumulate the necessary down payment. In the supply side, we have the flats of buy-to-let investors, and we have fixed period contracts in the rental market. Now, I think I haven't yet said, but one period refers to 1 month, and the rental contract is for 12 months. Now, let's look at some rules in detail. So every flat has 3 attributes: size, quality, and neighborhood. And each flat has the market price, which is the size times the market unit price of the given flat. Now, to determine the market unit price, we take the 2 closest recently sold flats in the neighborhood based on size and the state of the flat. Each month, the ask price is based on the actual market price, but if the flat cannot be sold, month by month, the ask price will be a decreasing fraction of the actual market price. The housing market in action, moving. As I explain how homeowners decide whether to move or not, it already sheds some light on how households select a home out of the flats for sale in the market. So, as stated earlier, households have a utility function. Actually, we simply call it a utility function, but it assigns a reservation price for flats. The reservation price of a flat is proportionate to the lifetime income of a household, and obviously it depends on the size, the state, and the neighborhood quality of the flat. The marginal utilities with respect to all 3 attributes are diminishing, and the utility gain of the neighborhood quality is irrespective of the size and the state of the flat. As you can see, the part containing the size and state variables is separated from the part containing the neighborhood quality. Why we separated the two? Why do we think the utility gain from the neighborhood does not depend on the size of the flat? It is because we think that neighborhood captures things like commuting time. People might value living closer to the city center to save time, which has a value for them. And it is irrespective of the size or the state of the flat. We had considerations on whether to separate size from the state, but when we try to calibrate the parameters of the utility function, our algorithm worked a bit better when we used the product instead of a sum. Now, there are 6 parameters in the utility function, 2 coefficients for size and state, 2 exponents for size and states, and 2 parameters of the sigmoid function for neighborhood quality. Now, these parameters differ household by household. So households evaluate the trade-off between size, state, and location to a different degree. Okay, now, each month we randomly choose some homeowners who can decide whether to move or not. We also generate fictive flats. We generate sample flats for all buckets, and we calculate their market price based on the price of the 2 closest recently sold flats. Now, the randomly selected households look through these fictive flats. They calculate their consumer surplus on all these flats using their reservation price according to this utility function and the price of the flat. And they choose the flat with the highest surplus. And they compare this surplus with the surplus of their actual home, again, using the market price of their own home. And if the surplus of the best fictive flat is substantially greater, then the household decides to move, and so it takes its home to the market. You might ask, why do we use fictive flats instead of looking at actual flats for sale in the market? We have multiple reasons for it. And one comes from the sequence of events in the model. In each month, we first collect the flats for supply to be sold. So we first construct the supply side. So when homeowners decide whether to move or not, whether to take their flat to the market or not, we do not yet have all the flats for sale. Another reason is that when someone decides to move, the underlying motivation is not a specific flat to move to. It is rather a sentiment that based on market prices, perhaps it is time to move to a bigger flat or to a better location if somebody can afford it. Okay, a third reason to remark is that we use fictive flats for other mechanisms of the model as well, like estimating demand for newly built flats or demand in the rental market. As the economy changes, people change, and there might be demand for flats in buckets where temporarily there is no flat for sale or for rent. And to estimate demand, we use these fictive flats. And there is a fourth reason as well, which comes from the bidding mechanism. And so let's move on to bidding. So bidding takes place when we already have the supply side. We have all the potential home buyers, first buyers, and homeowners who decided to move. Homeowners might still have their own home, or if they had already managed to sell their home, temporarily they might be without a home. Actually, if they still have their previous home, they might get a bridge loan as well to purchase the new one. So we have the potential buyers. Now, before making any bids, a buyer selects a fictive flat. This fictive flat represents what is worth waiting for at current market prices. Even if at the moment there is no such flat for sale, there's the possibility that sooner or later a flat like that would appear on the market. So each potential buyer has this fictive choice which serves as a reference. Now, when a household looks at a flat for sale, it calculates the consumer surplus, and the closer its consumer surplus is to the consumer surplus of the ideal fictive flat, the higher is the probability to bid on that flat. If a household decides to place a bid, the bid itself is the weighted average of the reservation price and the market price. If the household cannot afford this bid due to credit constraints, the bid is the highest affordable price considering financing opportunities. Now, when selling the flats, we go through the flats in a random order and we use a weekly auction. The highest bidder can buy the flat at the price of the second highest bid, or at the market price if there is only one bidder. If a household buys a flat, all its other bids will be withdrawn. Now, a complementary remark. I previously said that there can be migration within the country. Hungary has 7 NUTS2 regions and the capital, Budapest, and each region has its own neighborhoods. When making a bid, first buyer households can look at flats in more than one region, but other households only consider flats in their own region where they already had an own home because we assume that they got used to that region. Renovation. The quality of flats deteriorates in every month, but households can ameliorate them by renovation. Every month, a random set of households is chosen who can renovate their flats if they wish. Renovation itself has a cost. We have a unit cost, which actually depends on regional average wages. And so total cost depends on the size of the flat, what area needs to be renovated, and the extent of renovation, to what quality the homeowner wishes to renovate the flat. The optimal extent of the renovation is determined based on the consumer surplus, which can be attained by the renovation. Actually, when buyers evaluate flats, they take into account the option of renovation. They calculate the optimal renovation for a flat, which induces additional costs on top of the market price. And so it affects the consumer surplus and the bidded price as well. And renovation takes 1 month. Okay, a few remarks on construction. The construction sector builds flats of different sizes in different neighborhoods, but the state of these flats is automatically the highest. The reservation price of households for newly built flats is higher than what comes from plugging in the highest state into the utility function. Actually, we inserted an additional multiplier into the utility function in case of a newly built flat. The construction sector gets to know the fictive choices of households and so has an estimation of demand for newly built flats regarding size and location. And so it can decide how many flats to build in different size categories in different locations. Now, in order to build a flat, the construction sector needs building site in the specific neighborhood, and this building site is proportional to the size of the flat to build. To have a building site, the construction firm purchases the flats with the lowest unit costs in the neighborhood, and then pools the sizes of these flats into a construction site. Construction of a flat takes 18 months, so it can be a source of friction in the model. And construction cost is proportional to the regional average salary, but it is higher than the renovation cost. Flats can be purchased already during construction, and actually, the ratio of newly built flats sold during construction affects the markup used by the construction sector. Okay, and the price of newly built flats consists of land costs, construction costs, and the markup. So it is not calculated using the two closest neighbors, because the construction sector builds houses only if it can expect to sell them with an appropriate profit. Households have three sources of income. The most important is wage income. We have a very good available database for single salaries in Hungary. For pensioners, wage income is replaced by a proportional pension. Then households can have transfers in the form of family benefits, and buy-to-let investors can have rent income. Now, we estimated a starting wage for each individual in the model, which determines the wage path of individuals according to working experience. This wage path depends on the educational level of an individual, and we distinguish three educational levels. By the way, educational levels also have differing unemployment probabilities. Each month, we update the starting wage and the wage path for each individual by the nominal GDP index. And in this way, we implement a macroeconomic trend into the model. And so macro trend affects household income and households' lifetime income as well. And so it also affects house prices. Now, we ran the model with two distinct macroeconomic scenarios. The first one is a growing economy without a COVID-19 shock. It is based on the 2019 Q4 forecast of the inflation report, and we extrapolated the forecast until 2024 using the GDP and CPI trends, GDP and CPI. The second macro scenario is the COVID-19 scenario, which is based on actual GDP until 2020, and then the forecast published in the 2020 Q4 inflation report. In this scenario, we increased unemployment probabilities during the shock in a significant way, more than in official data, due to adjustment on the intensive margin and due to the extent of the gray economy. Now, please remember that when we make the COVID-19 impact assessment, we compare these two scenarios regarding GDP, this scenario and this scenario. Finally, let's see the credit market features. There are mortgage loans to purchase a house, and if a household is moving, besides the regular housing loan, it can get a bridge loan if it hasn't yet managed to sell its home. And households can get a loan to cover renovation costs. It is also a mortgage loan. There are fixed and variable rate loans as well. And as we move ahead in time, the share of fixed rate loans among newly issued loans converges to one to model the trend in Hungary, since Hungary has gone through a transitory period from variable rate mortgage loans to fixed rate mortgage loans. A household is eligible for a loan if it meets the LTV and PTI rules, which is a central regulation. And on top of that, the bank itself also uses a prudential rule. The household's expected income must cover the monthly installments and a minimum per capita consumption level. And third, to obtain a new loan, a household must not have defaulted in the past 5 years. When the bank tries to be more prudent, it increases this minimal consumption level. During the shock, it increases this level, which decreases lending. And due to this rule, bank lending is procyclical. Regarding interest rates, to determine the interest rate, banks set the credit margin with a regression model estimated on actual empirical data. If households become non-performing, they first try to reduce their consumption, then banks try to restructure the loan. But if a loan stays non-performing for 6 subsequent months, the flat needs to be liquidated and it is put on the market at a depressed price. Okay, so that was explaining the most important building blocks of the model. And now I would like to say a few words on input generation, how we try to populate the model with individuals, households, and flats. So we have individuals, adults, and children, and these individuals form households. We have single households, households with 2 adults, and households with at least 1 adult and children. The model has nearly 10 million individuals, the population of Hungary, and these 10 million individuals constitute 4 million households. We try to generate the individuals with their age, starting wage, educational level, and location based on a very granular database, which is in our case, the pension contribution data set of Hungary. Well, this data set could be used for many, many other valuable research projects, including agent-based macro models, but other projects as well. It contains all the revenues subject to pension contribution from 1998 on. In this data set, regarding every revenue, we have the following variables: the individual's ID, who gets the revenue, the gross income subject to the contribution, employment type. Regarding employment type, we have codes for a bunch of different income types, like normal employment relationships, public servants, but maternity benefits as well. Actually, we assigned children to households using this maternity benefit data. Then we have the weekly working hours, and we have the 4-digit ISCO codes, International Standard Classification of Occupations codes, which we used to determine the educational level of the individual. Then we have the date interval for which the revenue has been received, which is usually a month, and the location of the individual. Besides the revenue records for every individual, we have the birth year, the sex, and an ID to merge the individual to the central credit registry. And given so, we matched all the existing housing loans to households, except for data inconsistencies. So we matched the housing loans as of January 2018. This is the date when we set off our simulations in our empirical model. Besides many other data, we have, for example, the outstanding principal in January 2018, maturity date, current payment, even the market value of the collateral. And the market value of the collateral also helped in matching the underlying households to a flat of a proper market value. To generate the household stock, we use the data sets of housing market mediators and the transaction data from the tax authority between 2018 and 2014, 2018 and 2018. We use a separate data set for the interest rate of loans, but I think I would skip this slide due to time constraint. So we have great databases to generate individuals, flats, and we have the exact loan data. You could easily link loans to households, but we still had to link individuals to households and flats to households. Put it shortly, we used many algorithms to do this stuff, sometimes using other little snippets of data. But finally, we managed to have 4 million households, and each one is assigned a flat to live at. Whether it owns it or rents it, it is chosen at the beginning of the simulation, and the probability of rent depends on multiple characteristics. And we have the individuals constituting the household with their educational level, age, and starting wage, and actual work experience as well. We also have the flats arranged into 124 neighborhoods in altogether 8 regions. And the initial market value of flats in all these regions tries to reflect the aggregate real world market value. Before setting up the model for empirical analysis, we had to calibrate and validate it. Besides generating households and flats and actual loan contracts, there still are some parameters to calibrate. For calibration, we use data from 2018 and 19, and we wanted to get the empirical average prices for 2018 and 2019, the number of transactions, and the number of transactions of newly built flats. So we set up the model with empirical data in January 2018, but since we used the first 2 years for calibration when evaluating simulation results, we disregard these 2 years. So we start evaluation from 2020 on. And after calibration, we tested some variables in the credit market for validation. Okay, so first, average transaction prices, how they change from the first quarter of 2018 to the last quarter of 2019 in the NUTS2 regions. As you can see, we could more or less reproduce the significant house price increase in most of the regions. Pest megye could be considered the agglomeration of Budapest, and so we have the highest average prices in Budapest and Pest megye. In Budapest, the average price at the end of the calibration is somewhat lower. One possible explanation can be that capital income is more significant in Budapest, and we only considered wage income in the model. As you can see, we could very closely match the monthly average number of transactions on the housing market, just like the number of transactions of newly built flats. Regarding loan contracts and new credit flow, the number of contracts is slightly lower than the actual data, and the new credit flow is around 20% higher, but we think it's quite a good result. Now, the distribution of new credit flow along income deciles. In Hungary, housing loans are quite biased towards the highest income decile. By volume, almost 45% of new credit flow has been issued to households of the highest decile. Our model reproduced this slab-to distribution with a somewhat lower kurtosis. Now, looking at LTV categories, the distribution in the model is somewhat more even, but for us it seems quite convincing that we could approximate the empirical distribution to this extent without calibrating it. And now let's see the model in action by presenting 3 applications. First, let's look at a COVID-19 impact assessment. To assess the impact of COVID-19, we ran 2 simulations, one without a COVID shock and one with a COVID shock. I've already shown the 2 scenarios. But I would like to emphasize that we assumed a higher unemployment shock than what is reflected in official data due to adjustments on the intensive margin and due to the real economy. And we did not assume any policy interventions. Now, as you can see, there are significant differences in average prices in percentage points in all the regions. And usually the highest difference is in 2023. Then in most of the regions, the difference decreases. But even in Budapest, it is more than 10 percentage points at the end of the simulation. Budapest is the most developed region, And these four are the least developed regions in Hungary, especially northern Hungary. In these regions, average prices are way lower than in the central parts of Hungary. And the proportion of unskilled labor is higher, who are more hardly hit by the shock. And so demand decreases to a greater extent in these regions. Still, we need to admit that yet the model can produce some exaggerating figures as well. But if we wish to use the model for macroprudential purposes, perhaps we should not worry about it much, because these four regions, being the least developed, altogether constitute only a quarter of new credit flow in the model. And even within these regions, there is high heterogeneity between neighborhoods. And there are rural neighborhoods as well, where lending is even less significant. And for the regions most affected by mortgage lending, these figures are more or less credible. Now, as you can see, during the shock, the number of transactions in the housing market is around 25–30% lower, and it is mainly due to credit constraints. As you can see, the number of new loan contracts from one scenario to the other decreases by roughly the same absolute number. As you can remember, banks in the model behave in a procyclical way. They become more prudent in a shock. Okay. Now, until the end of the simulation, the number of transactions and new loan contracts more or less catch up, but new credit flow remains significantly lower, since average house prices are still significantly lower at the end of the simulation. Looking at the distribution of new credit flow along income deciles in the COVID-19 scenario, you can see that during the shock, new credit flow shifts significantly toward higher deciles, as lower deciles are more hit by unemployment. But even after the shock, the share of the two highest income deciles stays a bit higher, because lower deciles could accumulate less savings during the shock. And so in some cases, they don't have enough down payment for a loan contract. Loan loss provisioning during the shock is about 3 times that of the no-shock scenario, but then this difference disappears. As you can see, even in the no-shock scenario, loan loss provisioning decreases because a significant part of loan loss provisioning is related to loan contracts which have been issued before the start of the simulation. So actually, lending in the model is quite prudent. Now let's move on to the second application, the moratorium policy application. In Hungary, a loan payment moratorium was introduced right at the beginning of the COVID shock in March 2020. And so besides the no moratorium case, we looked at 2 different types of moratorium policies. We call the no moratorium scenario the full-scale scenario. And in the targeted scenario, the moratorium targets only households without sufficient savings to cover expenses for 3 months. And under general moratorium, no household has to pay the loan payment. The time interval is from March 2020 to June 2021. Without moratorium, the total volume of loans, including housing loans and renovation loans, decreases under the shock. A fraction is written off, and the outstanding principal of performing loans decreases, while due to credit constraints, new credit flow is significantly lower. Then, after the shock, as credit constraints do not bind that much, total volume of loans start increasing. Obviously, under general moratorium, total credit does not decrease because debtors do not pay principal and there is new credit flow. But it is the case even under the targeted moratorium. At the end of the simulation, the total volume of loans is around 15–20% higher under the general case and around 10% higher under the targeted case. We present the debt to income figures for households above the median, say, since they constitute about 90–95% of mortgage lending. If we look at the debt to income figures we can see that higher income deciles seem to be relatively more indebted, but since their income is significantly higher, they still have plenty to spend on consumption. During moratorium, households on average become more indebted since they do not pay principal, but this change in indebtedness is relatively higher in lower income deciles than in the highest decile, because interest rates for lower deciles are higher. Regarding loan loss provisioning, for the targeted and general scenarios, it is roughly the same, because it would be enough to defend households who really have financial difficulties. Okay, finally, the third application, experiments with the LTV and PTI regulations. We assess the impact of a less stringent LTV regulation, that of 90% instead of the prevailing 80%, for both the baseline and the COVID scenario. Similarly, for the PTI, we calculated the consequences of a more lenient rule by 10 percentage points, considering all kinds of interest rates and income levels. And here you can see that there are different PTI rules for different interest rate fixations and income. We only considered either the LTV or the PTI change at a time. Okay, now regarding the 90% LTV cap, if we look at the deviation of average house prices by region, we can see that under the shock, house prices are significantly lower. Then after the shock, they are significantly higher in all regions. So a less stringent LTV regulation makes house prices more volatile. Looking at the number of transactions, in normal times, it is slightly higher under the 90% LTV cap, because households can afford an own home more easily. But households also get more indebted. And so new credit flow is significantly higher in normal times. But under the shock, new credit flow decreases to roughly the same volume as under the 80% LTV cap. Okay, now, generally, lower income households are more credit constrained. And so relaxing these constraints causes a shift in the distribution of the new credit flow towards lower income households. But by lower income households, I mean lower income households among the creditworthy households. Actually, we can see an increase in share in the 8th and the 9th deciles, and a decrease in the 10th decile. Since with a 90% LTV cap, there are more loan contracts, the share in previous categories decrease, but obviously we can see the greatest proportionate decrease for the LTV values between 70 and 80%, because previously the 80% cap was the entry point for constrained households, and now some of these households could enter the housing market earlier with lower down payment, and so with a greater LTV. The 90% LTV cap has financial stability issues, both in regular times and under a negative shock. The loan loss provisioning as a percent of all loans can double or triple. Okay. PTI. If the macroprudential authority relaxes the PTI constraint as the prevailing 80% LTV cap, it just slightly affects the number of transactions and the new credit flow. Because with an 80% LTV cap, generally the binding constraint is the lack of down payment. And only a few households wish to spend more than 50% of their monthly income on accommodation. Since different PTI constraints are applied to different interest rate fixation, in reality, the relaxation of the PTI rules might change the type of interest rate fixation chosen by the household, but still the LTV cap remains the main constraint. So we can only see a slight increase in new credit flow because most households are constrained by the LTV cap, but those few who previously were constrained by the PTI and now get a mortgage loan with high indebtedness can cause considerably higher loan loss provisioning for banks. Okay, after presenting the results of the three applications, let me wrap it very fast. So our ABM gives a one-to-one mapping of the Hungarian housing market. There are several unique features in the model compared to the literature. We were able to calibrate the model to match empirical observations at the aggregate level and partly also for regional data and income deciles. We made 3 applications, a COVID-19 impact assessment, in which the number of transactions and loan contracts decreased to a great extent, and the lending activity remained permanently at a lower level. Then we made a loan payment moratorium policy analysis, where both types of moratorium policies decreased provisions and increased the volume of outstanding principal to a large extent. Finally, we made LTV and PTI policy simulations. Relaxing the LTV rule increases the house prices and the number of transactions, as well as the new credit flow, although provision might double in this case. Okay, relaxing the PTI rule has almost no effect on the housing market. There's only a slight increase in the flow, but a relatively higher increase in provision. Okay, now that's it. So I'm open for questions.
Thank you, Bence, for a very interesting presentation. I'm opening the floor for the questions. Please write a mark or your question in a chat box. I will try to read it loud. So I already see some questions from Andrea Gorgone, and some coincide with the ones that I could have. So if you allow me, I could read it loud, okay? Hi, thanks for your presentation. There are my questions. How is a down payment determined in your model? Is there a role for saving? It is the first question. There is a second one. Are utility functions homogeneous across households? And the third one, how do BTL investors and developers take their decisions? That is how we form expectations about the price evolution, I'm sorry.
Okay, I'm sorry, I have a small technical problem. I can't see the chat.
Okay, you should see it in a lower panel. You need to have a sign of chat. Probably you need to get out from your presentation for a second.
Okay, now I see the chat.
Okay, perfect.
Okay, can you still see the slides?
Yes, we do.
Okay, great. Okay, so down payment. So there is role for saving. So there is a saving rule. The savings ratio is determined according to the income of the household. The higher income a household has, the more of it can save. Okay, so it accumulates savings period by period. And actually, that's it. So it does not have a target for down payment. So there are no households which wish to have a 30% down payment or a 20% down payment. If they can afford a house, they purchase it. Okay, so the form of the utility function is the same for all households, but each household has unique parameters within it. So there are coefficients for size and state, exponents for size and state, and those differ by household. Okay. Yep. So BTL investors. Okay, so there are rents in the model, and so they can calculate their profits. The lower the vacation rate in the rental market, the higher are the rents. So first they can calculate their profit from renting out the apartment, and that is one factor. And they also take into consideration house price increase. Actually, they have an adaptive rule. So they don't really form expectations. If they see that house prices are increasing, then they tend to rather buy houses.
Okay, thank you. That's very clear. I don't have any other questions.
Thank you. I see another question by Adrian. Adrian, can you unmute yourself?
Yes. So I have a couple of questions. First of all, the fictive flats, is this some kind of a flat with an average price and average features for a certain bucket? Is this a correct interpretation?
Yes.
Okay, so that's like the average. Then can you remind us, how is it that the bank behavior is procyclical? Because you said it several times, and I'm guessing it has a a non-negligible influence in the model. But I don't get if its behavior is procyclical. How, via interest rates or?
No, by expecting more income of households. Okay, so there's a PTI rule of the central bank, I mean of the macroprudential authority, but a bank might decide to constrain the household if it thinks that its minimal consumption wouldn't be enough. And if there's a higher probability for unemployment, for example, then it wants to have a higher minimum consumption.
Okay,
and so it would give less. It would issue lower loan amounts to households of lower income deciles.
Yes. Okay. So it's not that it does anything weird with interest rates, but rather that
no.
Exactly as you say, it expects a lower income or a higher chance of getting unemployed or something like that. Okay,
exactly.
That's great. How do you calibrate the utility function parameters for each household, or are they just drawn from some distribution? How?
Okay. So we have the households living in a flat. So actually, as a first step, we matched households with a loan contract.
Yes.
To a flat of an equal collateral value, as in the loan contract. Okay, and then this flat had size and state characteristics and a location. And then we made a list of flats with their market prices, and then so which flat a household would choose. And the aim was to choose a flat similar to the flat where it lived.
I see. So because or you have first kind of guessed where each household actually lives, right?
Yes.
So you backtrack from there the values of the parameters that will give you that choice that the household actually does. Okay, that's smart. Okay, interesting. Okay, yep, those are all the questions. Thank you.
Thank you, Bence. I see that Yoros has a couple of questions. Yoros, please unmute yourself.
Well, thank you. Thank you very much for the interesting presentation. Actually, I'm very sympathetic with the process of calibrating agent-based models to empirical data. And in fact, my first question is related to that. Could you go to the calibration slide, please?
These results?
I think that one. Actually, that will serve for the second question, actually. Well, the first question was, you mentioned that you discarded the first couple of years of data since the start of the simulation. Could you elaborate on that? Why was that the case?
Oh, no, it's just when we saw the policy results, we did not include the 2018 and 2019 prices. Actually,
it was not for the calibration.
We used the 2018-2019 for calibration.
All right. And so after the calibration, the simulation starts and you didn't discard any data, right?
No. So the simulation starts in 2018. We just disregard 2018 and 2019 and show the results from 2020 on, for which we did not calibrate the model.
Exactly. And you mentioned that actually in the slide just before that one,
calibration.
Exactly, the calibration one. The data, the aggregate data match sufficiently well, I would say. Exactly that one, the historical data. But if I understand correctly, these are the annual averages, right?
Monthly averages, but for monthly averages, but in this case for 6 quarters.
No, not
okay. Here,
average house price.
Here yearly average. I'm sorry. So regarding this slide, these are yearly averages, monthly averages.
No, about the house prices.
The house prices for quarters. Okay, so 2018 first quarter and 2019 last quarter.
All right. So you could run that for more years rather than the 2 years ahead, right? So to see how the model would compare to historical data in 2 years' time or more.
We can, because actually we already have the 2020 data. For 2020, now our model has a bit more serious decrease in house prices. But 2020, it is a special year because there is a shock. I mean a very special shock, which is very hard to model. So we could also compare it to the 2020 figures now. But as we see now, this model for this shock, it makes a much more severe decrease in house prices.
All right, I understand. Okay, these were my questions. Thank you very much.
Thank you very much.
Thank you, Yorgos and Bence. Okay, Marco Bangallo has a broad philosophical question. Marco, please unmute yourself.
I don't know really if you wanted to ask your question also, because you've been waiting for a long time. But no, so I was just curious because, so I really love the fact that there are so many presentations on data-driven agent-based models, ABMs calibrated with microdata. I think that that's really good. I was just curious to hear if you had any impression on how your results changed as you, so probably you calibrated your model on real data from the start. So you probably haven't run simulations where you kind of calibrated it on fake data. But I was just curious if you can get like, for instance, that a policy completely changes if you calibrate the model in the proper way, as opposed to like the Bank of England model, which is more or less calibrated on everything that is synthetic. So my question is, well, whether you thought to actually compare your results to a situation in which you didn't calibrate in this detailed way to showcase all your effort, the utility of all your effort of calibrating it so well on real data, or if that's something you consider to do.
I don't think I exactly get the question.
Sorry. So in other words, yeah, I can say it with other words if it's useful.
Yes, go on, please.
Yeah, sure. So in other words, you basically had this model in which all households and all loans and all homes were really calibrated to the real ones in Hungary. And that's super cool. But I would expect you could also have done like in the Bank of England model, in which pretty much, so, you know, there is some calibration, but it's not as detailed as in your case. So you could have taken exactly the same model as your model, but instead of calibrating it on real data, you could just make up assumptions and, you know, create a population which is not the real one, but which could be plausible. And then you could compare results. And basically, then you could say something like, with the proper calibration, we get this important policy result, which we wouldn't have gotten if we didn't the proper calibration. So I was just curious, because in some sense, it's cool to say that detailed microdata calibration is great for as an input, right? So because it's nice, but then like being explicit about the value added of that would be great.
Okay, we haven't thought about it. So does your question refer to whether, I mean, so in this model, we have the right directions when we implement this or that policy? And is your question referring to whether we would get the same directions without a less sophisticately calibrated model?
For instance, yes.
Yeah, we haven't thought about it.
Okay, yeah, no, sure. It's just, okay, as I said, it was just a broad curiosity.
Yes. We haven't thought about it. We think that the value of it might be to have a more profound estimation for losses in the bank sector. Again, not very exact losses because it's still a model. But since we have the real empirical data, perhaps the magnitudes are more relevant, I would say so.
Okay, thanks.
Thank you, Marco and Bence. Last minute question, if there are any, there is any. If there are no, I had a list of questions. Partially it was answered due to other questions, but in particular by Adrian and Andrea. And I filter some that could be fast, and they are more about some curiosity questions. I would like to know how the agent choose between the fixed and variable rate mortgages, how this choice is happening, how this split is happening. To have an idea how big could be the model, I would like to know how much parameters you have in the model, roughly. And another curiosity is, there are a couple of IBMs on a housing market, and I was curious why, for example, on a classical manner, we don't see debt service to income or debt to income ratio, rather seeing PTI. Is there a particular reason that you went to that direction? I have other questions, but they are longer, so I prefer to contact you separately. Okay. So those are probably going faster. Okay. Thank you.
So regarding the choice of variable rate and fixed rate house loans, that's only parameters. The behavior itself is not modeled, it is just probability. That is just probability, so we haven't modeled yet. Okay, a PTI and that, why there's only PTI and LTV, it is because in Hungary we have PTI and LTV requirements and nothing else. But we could make it for other requirements as well. And what was the third question? Sorry.
About how big is the model? How many parameters do you have?
We haven't. I haven't counted it all over yet, but it's around 200-300 parameters. There are many small parameters in the model. So there is a configuration file, and there we have like about 200-300 lines of code. But sometimes we switch on and off some parameters. So we sometimes switch on one rule and switch off another rule, and each rule needs different parameters.
Okay.
which is in the code, but roughly around 200-300 parameters.
Okay, Bence, thank you so much. We are a bit out of time, so let me thank you again and close the seminar, and see you in 2 weeks for the next one. Have a nice day. Thank you.
Yeah, thank you. Goodbye.
Thank you,
Goodbye.
everyone. Goodbye.
Bye-bye.
Goodbye.